Good morning. It's Vince Lanci. It's 8:03. We are a couple minutes late, and I am broadcasting the Gold Fix with compliments to the Opportunistic Trader. Opportunism is different than opportunistic or opportunity. Seeing an opportunity to do something is not being opportunistic or a firm, which we'll get into in a little bit, on seeing an opportunity to make money without providing a service for clients. But I don't want to become a socialist here and alienate everyone on the site. But I do have some things to talk about today on how bigger brokerage firms are following their corporate mandate to make money, and in doing so, the next thing you're going to be pitched is to how to short stocks. Before we do that, let's talk about gold. Yesterday, right? Let's get rid of all this stuff here. All right. Okay, and we'll even get rid of that for the moment. Okay. So yesterday, there you go. This is that's the 1 hour. All right. So here we go. We can look at the day just so you can get a perspective. Gold was a little bit stronger yesterday. And I say a little bit, don't get too excited about it. It's just in a little bit of a range. But against the backdrop, you look at yesterday's activity in gold and you say, no big deal. You can use your old technical numbers and all that stuff. But I want to talk about it in context and talk a little bit about conditional probability and how it applies to making trading decisions when you don't have all the information. And believe me, we don't have all the information. So the first thing I did yesterday, because I really didn't have any signals in gold, I traded the S&P profitably, but of course took like 10 handles out of a 3 million handle move, which is typical of the system that I have. We'll get into that trade to show you how it worked and how it protected me, and then how it cut my profit short, or I should say me. But before, and it applies because that system applies to gold. It just happened to work in the S&P. You will remember if you listened yesterday that I mentioned that all markets. I said all. I don't know if I said all, but I'm saying all now. All markets behave properly technically, even though I hate technical analysis. I have to admit it. That gold is just slower than markets, and that's why a system that I have used for years, starting with hedging gamma, and then for letting initially to let profits run versus taking profits, has evolved into a directional system. It works like technical analysis, although it's different in every market once you find the right parameters for it. The point I'm making is if you're looking at gold as a trading vehicle, as I do, don't be disheartened by its behavior. It's not the type of market that gives you intraday swings like other markets do. It is relatively an illiquid market, and therefore it's given to not doing anything until it does something. And by that, I mean, think of books like The Tipping Point. Think of concepts that I raised called that life isn't a straight line, it's plateaus, and fits and starts. And that actually offers a great opportunity for gold people. If you understand the technicals and you're not actively trading minute by minute, nothing's wrong with that. I do it all the time in markets that move when markets are moving like that. And gold has its moments like that. But gold respects the technicals. And because it needs a tipping point and it's not continuously liquid. If you remember, we talked about options volatility or volatility of markets. It's not as continuously liquid. It lags. It's inefficient for longer periods than other markets. You may feel frustrated and you may get out of your position. But if you increase your time frame, if you trade, let's say you're just to make a note, you're 10 up in the ES, intraday day trading, or let's pick a number that's more reasonable to individual active traders under with a net worth under $5 million. So let's say you're 5 up in ES. Okay. Uh, uh, you might want to be, but you're 5 up in the ES and you're making more money in the ES, and because maybe you used to trade gold, but you don't trade it anymore because you're frustrated. In gold, you have to remember three things. I'm sure there's three things. I'll make the third one up if there isn't. The first one is gold is a very big contract, and because of that, it takes a lot of money to trade, and because of that, you're encouraged to use leverage, so you can buy and sell on margin and not put as much money up. But that is, a double-edged sword. Leverage is a double-edged sword. So that's the first thing. It's a big contract. Because it's a big contract, it does not attract retail investors. That's why the ES was created. The S&P got too big, so it's kind of like a stock split. They want more continuous liquidity. If you go to a local bodega, if you're from New York, and you own a local bodega and you sell a pack of cigarettes a day, you could probably sell 40 loosies or 40 loose cigarettes at the same day at a higher price. But the point is, the smaller the contract, uh, other things not factored in, other parameters frozen, the more likely you're going to have active trading. So number one, gold's a big contract, and as a result, it doesn't attract continuous order flow. Two, gold is a small float. It's money. I'm not saying it's a currency. I am saying it's money, but it's a small float. And because it's a small float, you won't attract bigger investors who don't have a problem trading a big contract, because it's a small float. Exit strategy is very important. That and these and other factors, I'm just touching on factors here, are reasons why gold seems inefficient. So what I'm saying is, if you trade 5 lots in the ES with an intraday stop, you trade 2 lots in gold with a 2-day stop, or you trade 4 lots in gold with a wider stop, or I'm sorry, you trade 4 lots in gold with a stop of X, or you trade 2 lots in gold with a wider stop. The point is not so much that gold isn't a technically reliable product. It is 100% technically reliable. The point is that gold's volatility is discontinuous. Its liquidity is discontinuous. Nobody cares until it's too late, and then it just kind of goes where it's supposed to go. And let's face it, there's a lot of lower lying fruit out there, which is why, although the system that I use was devised and optimized for gold and silver actually first, it makes more money in the S&P and oil. So the point is, if you have patience in gold, like and his name came up a lot yesterday, Gunlock, you're buying gold at 1180, and let's say that you do have limited capital, you have a stop in, you trade smaller, and you just walk away. Uh, let's say you're a micro trader. You buy gold on a stop level in above a certain level, and you stop yourself out. The point is, gold is not uh, 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 untechnical. Just change your time frame. And the only reason I can talk expertly about this, at least in my opinion, if I can be so arrogant about that, is that time is important for options traders. Time of efficiency. Everything regresses to the mean. It regresses to the mean. Well, over one day, over 1 month, over 1 year. That's understanding options. Anyway, the point is, now that I've wasted 10 minutes on that, is gold did nothing yesterday, which was really cool. So let's, you know, verbally, and this is off the top of my head, I really did not prepare for this, because I was too busy, uh, banging my head against the wall against an advertisement I saw, which we'll get into, and uh, uh, you can participate in my angst, or laugh at me. But the thing is this: gold did nothing yesterday. I want to just say, you may as well call it unchanged yesterday, and the stock market swooned. So in the past, and I've seen it both ways, and I've anticipated both ways. A big sell-off in the stock market, say for example, going back to 1987, caused gold to go down because people were told to sell their gold to cover their margin calls in stock, and the gold was called limit up, ended up limit down. And there you have it. So one example of gold dropping in a quick, violent move lower, it's at least a 50% chance that gold swoons. Uh, uh, and that's because uh, it's a matter of liquidity. We need money for margin calls. We're not going to sell our stocks. So, we're going to sell whatever we have profits in to close it out. And you've heard me say that gold is an insurance policy to be cashed out when you need it. It's not um, something you buy as the stock market is dropping. So there's the case for gold being lower yesterday. Here's the case for gold being higher yesterday. I don't think there really are a lot of longs in gold right now. These are opinions, but these are things that I weigh and handicap. Again, you have to handicap this stuff because we are all uh, traders, investors, people not on the inside. We are all mushrooms. And by that, uh, I've said before, and I'll say it again, we're kept in the dark and we're fed a load of crap. And so, from what we've been given in this darkened room, we have to uh, induce, we have to figure out or handicap probabilistically what's going to happen next and know how to act when the market moves. So that's the method we're using here. So what's the case for gold going higher when stocks go higher? Well, gold goes higher when stocks go higher. Is that possible? I mean, what's the case for gold going higher when stocks go lower? Well, that will almost always be accompanied by a violent move in the dollar higher, usually from an exogenous event like a war or a crisis that causes everyone to go flight for safety. Uh, However, recently, I've seen a lot less of that impulsive buying of gold in flights to safety. So after the Brexit debacle, when everybody bought gold and then got hammered 6 months later, when the dollar and gold go up at the same time, uh, the competition usually ends with the dollar winning. Now, so let's look at the dollar yesterday. The dollar yesterday was weaker. Okay, it was down, spot 30. All right, or 0.3%. All right. What would that mean for gold? Well, there is a correlation, but the thing is, the correlation the direct correlation between the DX and gold is not what it used to be, and that's because there's a stronger correlation, in my opinion. But everything's empirical, okay? But this is how I'm trading it. Gold has a stronger and increasing correlation with the Chinese yuan. So uh, these are all things I'm thinking about. So why didn't gold? The reason that gold was neutral yesterday, and I call it violently neutral. Nothing happened. People were too busy to trade gold. They didn't really have a lot to sell in gold. Uh, 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 Look at the opposing forces on gold in a sell-off in the stock market like that. One would be the simplest, most direct thing that would cause gold to go down. Would go to an hourly. Would be a sell-off in the stock market. Okay, causes people to liquidate gold. All right, to cover margin calls. But the dollar is weaker, so that causes people to buy gold. And there's your highest probability by my handicapping reasons for gold to do what it did, which was basically nothing. You had dollar based buying, weaker dollar, higher gold, and you had insurance selling. I call it insurance because they're selling. People were selling gold yesterday to free up cash to cover margin calls. No different than Venezuela selling gold to pay debts. No different than Germany after World War One having to sell all of its gold to eat. Um, so there are other factors, but the factor that matters to me most, the two factors that explain why didn't gold do anything significant yesterday were this. For me, the highest probabilities are you had buyers based on dollar weakness, and you had sellers based on stock weakness. Uh, Bonds were lower. Sorry, bond yields were lower. Who cares? I don't care about yields when it comes to gold. The dollar was weaker. Okay, that's bullish for gold. and we're going to move on from there. But I want you to keep that in mind, because gold, the next big rally in gold, and I mean like 100, 200, $300 rally, is going to be the end of QT or the beginning of QE or monetization of debt, which I think is not going to happen until the stock market gets to 2000. That's where the Powell put is. So why don't we go to the stock market and discuss it as it relates to gold. But before we do that, I want to show a couple things to you, not on my system. We're not going to really focus on that here today, but look at, if you're a technician, listen to me. I sound like the 5-year-old I am. All right. The daily chart here, right, in gold, uh, uh, just picking an example. If a person looks at this as a potential bull flag, meaning the market's going up, bull flag up, bull flag, bull flag meaning it's, it's not too many things down, it doesn't break a certain level or a Fibonacci thing, and we're in the area of potential bull flag breakup, right? If you like that, oops, it's an accident, then you like that more, because that is a more convincing bull flag with what could be perceived as I guess, a morning star if you're a candle guy. Now these wicks bother me, but there's an example. Uh, uh, Gold trades against the yuan technically cleaner than it does against does against the dollar. That's just a fact. That's just the way it is right now. Now, when gold gets really hopping, it'll trade technically on a shorter term basis, but right now it's not. Actually, we will do this. Let's put this up here. All right. So on a daily basis, we have nothing. All right. On a 4-hour basis, nothing. And on an hourly basis, we could have. I wouldn't put too much faith in it. Maybe 6 hours from now, maybe today's close, we get something. Uh, on a weekly basis, um, bullish breakout here. Depending on where you put your stop, you should you should not have been stopped at if you used the hard stop of 1234.80. Uh, uh, However, I didn't use that stop and I closed that at a higher level, which like was basically near the low. But you would still be long if you use the wider stop. So instead of trading 5 lots, if I had traded 1 lot and put my stop where it should have been, I would have still been long. So it's a matter of, how do you want to use your capital? Okay, so the bull scenario is still intact here, and as far as I'm concerned, remains intact. Although this assumes you're not showing stops, as long as we're above 1234.80, or a weekly settlement on a print, or a weekly settlement above 1241.58. All right, let's go to the SPX, or S&P, and go through the trade yesterday. All right, this was an hourly trade. Oh, I'm sorry. Before we do that, let's do the technicals. Um, okay, if we break above 1255, or even just above, well, even if we break above 12, look at the range first. Upside, if we break above 1255 to 1245.70. All right, that's the upside downside. So that's the trading range, the initial trading range, which is $10 wide, shown here on Moore's technical analysis. So 1255 is a level, all right, 1260 is a level, and then above that, I have the 1280s. But again, please do not forget 12, depending on how you measure it, 1262 to 1268 is, I think, going to be a big level of stop buying combined with macro selling because of that 12-month moving average I refer to so frequently. If you look at the downside, uh, a break below 1240 spot 40, you can have a significant move lower. Look at what other things are doing before you make a trade there. But it seems to me that there won't be a lot of attention on gold until the Fed actually speaks, which will affect the dollar. People are looking for QT to end. Maybe that's why they're buying gold. People will say, I don't buy it. Gold doesn't really have the future prognostication skills that, say, the bond market does. Gold is a lagger, not a leader, as far as I'm concerned, in predicting economic activity. You don't express your opinion 2 years out in a product that can handle a 5 lot buy stop. All right, uh, back to the ES. All right, so yesterday on the hourly basis, we got this. All right, and we shorted the market in here on an hourly break, but we expressed it in the SPY, and we took out a nice little move here. And I violated my own rules by risking one to make one. Anyone who's in the chat can see that. I think I might have put a picture on Twitter on that as well. But what happened was I sold it at uh, we'll go to the SPY, 250. Where were we? 250 here. All right. I sold it at 259 and a quarter, and I covered at 257 and a quarter, which is actually kind of cool. Uh, but the reason I covered was completely undisciplined. I should have stayed short because the market, uh, the signal said to stay short, but I covered and got long because I thought there'd be a quick reversal or swing trade higher, not a system trade. I was wrong, so enough of that. But then again, then the market continued lower, and so there you go. Capturing 5 to 10 handles of a 50 handle move is typical of that system if you don't trail your stops properly. Before we go, and I have to go quickly because we're running out of time, the AM roadmap, and Larry is back. We can talk about this another time. I want you to look at this video without listening. Oh, wait. Oh, crap. All right. I want you to look at this video without listening. Look at the man's face and how excited he is and how emotional he is. This is something I learned in Marketing 101. Turn off the volume on advertisements and watch people's inflection, watch their body language. This is exciting. I want to do it. I'm going to be happy. I love this. I can't wait to do this. That's what I'm seeing. Now, obviously, I'm projecting my own things, but look at what he's talking about. You would think he's talking about Christmas presents under the tree. He's talking about shorting options, and he's smiling while he's telling you there's risk. Here's a clue. Whenever you want to convince someone of something and disagree with them at the same time, you don't say, I like what you're saying, but you're wrong. Or, but this could happen. Because the word but means behold the underlying truth, B-U-T. When you want to convince someone of something, you don't say but, you say however, to show that you're a risk manager. When you want to convince someone of something and really, really kind of confuse their brain cognitively, you say, I agree with what you're saying, and I think you're wrong. When you put the word and in there, you mess people up. Let's see what this guy says. Now listen to the words that go with the picture, and then I'll let you go. I want you to pay attention to this because this is what you're going to be sold on next. Short selling can help you profit from a stock's decline. However, because it involves unlimited risk, you must have a plan. Listen to that again. Short selling can help you profit from a stock's decline. However, because it involves unlimited risk, you must have a plan. This is a carnival salesman. And I'm not attacking the firm mentioned in the lower left-hand corner. I'm saying that's his job. And he works for a company, and all these companies are made to do is make money. You were an investor, they converted you into a trader, and now they're telling you that it's okay to short stocks. You must have a plan is a disclaimer. They're not going to give you a plan. They're going to give you a broad idea of a plan. Uh, just be careful. The next product is going to tell you to short stocks. And that's insane. I'm not saying it's not insane. I'm not saying it's not something to do, but it's not something to do if you're an investor. Okay, 828, we got to hop. Just take a look at that, okay? If you see an advertisement like that and you want to short stocks, by all means, but be educated. And here's the plug: you want to educate yourself? Subscribe, because we've got people who short stocks here all day long, and they know their risk and they know why they do it. Opportunistic Trader, Larry Benedict. On behalf of Larry Benedict and the rest of the team, thank you and have a great day.